It's still in the conversation because of the AI agent narrative. The real activity around agent launches and trading, the multi chain expansion, and the simple fact that any protocol positioning itself as infrastructure for autonomous on chain agents continues to draw attention in a market that remains heavily focused on AI themes. If this is useful, hit the like button, subscribe if you haven't already, and leave a comment with your honest take on virtual. I actually read them. Looking at ratings and signals, a lot of the technical scanners and community sentiment have leaned cautious to outright negative for an extended period. You'll see a mix of hold and sell readings, especially from tools that track the longer term trend and the position relative to key moving averages. Funding and open interest in the derivatives markets have flipped around, but the short term outlook from pure chart based sources remains defensive until price can reclaim and hold above recent resistance levels with convincing volume. There is more coverage for virtuals than for lower ranked names because of its ranking and AI narrative, but the consensus from technical and sentiment tools has stayed measured rather than strongly bullish. What's going on with Virtual's protocol right now? The chart has been under pressure for a long stretch. Sell signals keep appearing on the higher time frames, and yet some people still argue this thing is somehow undervalued at these levels. How do those two views even sit together? Let's talk about it. Virtual's protocol is a decentralized infrastructure layer for creating, owning, and monetizing autonomous AI agents. It allows users to launch tokenized AI agents that can hold wallets, interact with users, generate revenue, and operate across gaming, social, and other applications. Virtual is the native token used for agent creation, liquidity pairing, governance, and ecosystem transactions. It currently ranks near the top 100 by market cap, with a circulating supply in the mid hundreds of millions out of a 1 billion maximum, and the price has been trading near the levels you're seeing after a sharp decline from previous cycle highs. On the technical side, the bigger picture remains a clear long-term downtrend from the much higher levels reached during previous AI-driven runs. Price has spent extended periods making lower highs and lower lows, with recent action testing support near multi-month levels. Short-term bounces have occurred but have consistently failed to reverse the larger structure. Momentum indicators have been mixed to weak on the higher time frames, often hovering in neutral to oversold territory without producing strong sustained recoveries. Moving averages on the daily and weekly still lean bearish, and volume has been relatively subdued outside of occasional spikes. Short term, it feels more like a weak consolidation or bounce inside a larger corrective structure than a clean trend reversal. You can argue there is some resilience when price holds the recent lows, but the overall structure still looks heavy. That's the classic trap setup. The technology story is real and the narrative remains relevant, but the market keeps assigning it a lower valuation while attention stays elsewhere. Retail often gets caught here, buying the AI agents will eventually matter argument, while the larger trend remains downward or sideways. Here's the real debate. Is virtual actually undervalued at these levels, or is this a value trap after a large post-run decline? One side points to the AI agent infrastructure model, the activity around agent launches and trading, the role of the token in liquidity and creation, the distance from previous highs, and the idea that autonomous agent platforms could re-rate if capital rotates back into AI narratives. They argue that if usage of the agent layer continues to grow and the token remains central to the economy, these levels could look reasonable in hindsight. The other side says look at the chart and the market structure. Many AI related tokens that peaked during strong narrative runs have struggled to hold value once attention faded. Volume and momentum have been soft for long stretches. Competition in the AI agent space has intensified, and the market has consistently treated virtual as a lower priority name despite the underlying activity. Short term, the picture still looks more consolidative and reactive than impulsive. You need to see stronger volume and a clean break of the recent resistance cluster before the short-term bias flips with any real confidence. Longer term, it comes down to whether Virtual's protocol can convert its AI agent infrastructure into sustained demand and relative outperformance for the virtual token. That's the only path that turns these levels into something more constructive instead of just another extended consolidation or grind lower. Nobody knows which way this resolves. The chart is still fighting the technology narrative, the protocol continues to support agent activity, and the market remains selective about which AI stories it rewards. So the real question is simple. Is this the kind of project that can finally break out of its long underperformance and re-rate higher? Or are we just watching another established AI infrastructure token settle into a prolonged period of low relative interest while people argue about valuation? Bull case versus bear case is fairly clear. Best case, broader market risk appetite returns to AI narratives, agent activity on the protocol grows, the token remains central to liquidity and creation, and price manages to reclaim key resistance levels and start building a higher base. In that scenario, you could see a meaningful recovery toward previous intermediate highs over a longer horizon. Worst case is the opposite. Volume stays muted relative to peers, relative performance continues to lag, and the downtrend simply grinds lower toward new cycle lows. In that scenario, the undervalued talk just becomes background noise while price continues to underperform. Risks are meaningful, volatility is still present. A broader risk of move in crypto or continued rotation away from mid-cap AI tokens can pressure the price further. Downside remains open if the recent support zone breaks and the downtrend simply continues. Retail traders love the long-term autonomous AI agents and on-chain economy story and end up holding through multi-month or multi-year underperformance. Liquidity is solid relative to pure micro caps but still thinner than the very top names, so larger moves can still happen quickly. There's also the structural risk that comes with any AI infrastructure play. The narrative has to translate into sustained agent usage, real revenue flows, and relative outperformance, otherwise, the token simply fades.